Welcome back to another Stock Market Open Live! What's gonna happen today? Will there be a continued larger cap sell-off? Will it just be a rotation into the small caps? Will it be an everything sell-off? Who knows? Or maybe everything will just go back to the moon, which would be the best case scenario. So, let's see what we have here. We've got a PPI coming out in about 30 seconds. And let's see here. We are going to watch for PPI expected to come in at 0.1 on the survey. Then on the month over month, we're looking at 0.2 and 0.2 on the other. I don't expect anything bad here. I think this will be pretty benign. And let's see what we get. But we're sitting here on the Qs at 4 basis points. So let's get a good number again. Let's go for some good news here. On PPI, it's obviously less critical than CPI, but we'll see what we have. Well, I see a giant red candlestick there. I don't even have the number yet. Jeez, what happened? Oh, it came in at 0.2. Core PPI came in at 0.4. So it actually, PPI came in actually a little warm. Food and energy came in at 0.4. Month over month came in at 0.2 versus the 0.1 expected. All right. And then X-Food Energy Trade came in at 0. So once you exclude it, so some form of trade inflation there maybe or something. So we're going to have to dive into this a little bit, try to figure out what's going on. On the year-over-year numbers, wow, the year-over-year numbers came in hot as well. Not great. So the year-over-year numbers, you got 2.6 versus 2.3 and 3.0 versus 2.5 expected. How interesting. All right, let's find out what's in the weeds. Let's listen in here while I pull it up.
If we look at year-over-year final demand, that's coming in at 2.6. Definitely hotter than a 2.3 expected. In the rearview mirror, at least up to now, 2.2. 2.6 is the warmest since March of 23, over a year. If we look at X-Food and Energy year over year, 3%. That's a 0.5% hotter than expectations. Follows 2.3, and 3% is the warmest. And I have to go back a bit here to April of last year when it was 3.1. And finally, year over year, X-Food, Energy, and Trade, 3.1, following 3.2. 3.1 would be the warmest only since April when it was 3.2. Now, we have revisions coming across everything. Let's go over those. On headline, last month's minus 0.2 moves up to unchanged. Strip out food and energy, last month was unchanged, moved up to...
all of them revised up.
Stripped out food, energy, and trade, that was unchanged. That now becomes up 0.2. The years over year, headline, 2.2 becomes 2.4. X-Food and Energy from 2.3 to 2.6. X-Food, Energy, and Trade moves from 3.2 to 3.3. So universally, every category, all 6, last month getting revised higher, and everything but 1 is higher than expected for this month. Yields haven't moved up as much as I would have gleaned because PPI never has the impact when it comes in second on the calendar of events post CPI. But we are seeing a 422.9, 423-ish in 10s, and they were at 420 before the number, and 453, 452.5 now, and before the number that was 449. So several basis points higher. Once again, you want to keep in mind 460 for a 2-year and 4.25 for a 10-year on important pivots for closing the week. Joe.
All right, let's take a look at the actual report here. Oh, interesting. So, all right. It seems like the market doesn't really care, though. I mean, the Qs are basically flat. Let's see here. So, producer price index, seasonally adjusted. I wonder if there was some form of weird seasonal adjustment here. Let's see here. Final demand services. The June... Because, see, the thing is, PPI usually leads CPI, right? Producer prices go up, and then consumer prices go up. Not always, but it's a pattern that's seen. Producer price index for final demand advanced 0.2% in June, seasonally adjusted. Final demand prices were unchanged in May and increased 0.5% in April. Okay. On an unadjusted basis, the index for final demand rose. Okay, we saw that. We read through these. Okay, so the June rise in the index for final demand can be traced to a 0.6% increase in prices for final demand services. In contrast, the index for goods decreased 0.5%. All right, so a little bit of a good and bad there. I mean, you want to see the goods deflation. You don't necessarily want to see that rise in services, though. Prices for final demand, less food, energy, and trade services were unchanged in June, following a 0.2% advance in May. That's once we took out trade services. So what happened here? Final demand services. Let's see here. Nearly all of the June increase is attributable to a 1.9% jump in margins for trade services. Margins received by wholesalers and retailers. The index for final demand services, less trade, transportation, and warehousing inched up 0.1%. Conversely, prices for demand, transportation, and warehousing fell. Okay, fine. So, product detail. Over 1/4 of the June advance in prices for final demand goods services can be traced to a 3.7% rise in machinery and vehicle wholesaling. Okay. Indices for automobiles, automobile parts retailing, deposit services, fuels, computer hardware, software, service, supplies retailing, wholesaling also moved higher. A lot of categories here that moved higher. In contrast, the prices for truck transportation and freight declined. And loans, real estate loans declined. Well, this makes sense. Prices for final demand goods moved down 0.5% in June after falling 0.8% in May. Most of the June decrease is attributable to a 2.6% drop in the index for final demand energy. Prices for final demand foods declined 0.3%. Okay. Let's see here. It's not exactly clear right now. I want to see this final demand trade services. Trade services. Okay, got it. Let me, I'm going to go for a detail here. And let's see if we grab a detail sheet, if we can find out a little bit more about what's in there. Final demand. There we go. Let's open this up. Let's see if there's like one particular hot thing. It'll take me just a second to pull it up, so we'll hop in over here just for a moment.
At all. The Fed's thinking about a cut in September.
I think it's worth putting, today's numbers next to yesterday's CPI numbers, which came in cooler than expected. And I think probably we'll see, core PCE still shake out somewhere in the neighborhood of where it has been year over year, which is about 2.5%, which is still, looking at somewhere in the neighborhood of 250 to 300 basis points of restrictive territory for the Fed. So I'm less fussed about, whether today's numbers come in slightly hotter than expected, especially given yesterday's numbers, and more focused on the bigger picture, which is the Fed has a whole lot of cutting to do, and quickly, especially given the recent unemployment uptick to now 4 to.
Yeah, this is like a trade inflation report. It's really weird. Like, it doesn't seem like. That's what I mentioned when I first saw the data. It didn't seem like it was, something other than trade. And the reason I said that is if you looked at the PPI if you go to PPI X food, energy, trade, you're at 0. But if you have trade in there, you have a lot of inflation because final demand ended up. And then final demand, X food and energy ended up. And then everything got revised up. But once you took out trade, the numbers were benign. And so then I go over here and I look at trade services. And look how high some of these numbers are. Trade of private capital equipment, 3.6%. Trade of personal consumption goods, 1.7%, which it was last month as well. But trade of capital equipment was negative last month, whereas now it's substantially positive. Trade of government purchase goods, negative last month, substantially positive this month. Trade of exports, negative last month, substantially positive this month. So it seems like this is really just kind of like, I don't know, it comes across hot because of some weird stuff going on in trade. I don't think this is actually a bad report. Yeah. I mean, a bunch of negatives over here. Final demand goods, less distributed, less various different services. You know, I mean, some of these are a little warmer, but I don't know what's going on over there with trade. It's just like some sanctions hit this or something. It's weird. Okay, let me see what they're saying over here. I'm going to get some other notes because this is a weird one.
Professional lifetimes, we've had the Fed asking fiscal policy to move. You don't get to choose your political windows in Washington, and guess what? This administration...
Yeah, see, people are now sort of just running around with this idea of, oh, U.S. prices surge at fastest pace in 15 months as service costs soar. Yeah, it's true that the service numbers went up, but trade services. So I don't think that's necessarily a bad thing. Because, well, let's see here. Whoops. At least a modicum of the optimism derived from the CPI figure may have taken a hit after PPI rose more than expected on a headline and ex-food and energy basis. Well, that's true. All of it was hot. Moreover, there were significant upward revisions to prior data. Number crunchers will need to pour through the details to tease out the components. Yeah, I'm working on it. I don't know. Let me see if the Doomers have something on it. PPI is a little harder of a one to read. Let's see what they have.
We're just about unchanged now on the session at about 450.82. Not major moves, Mohammed, but they're the moves of the last 10 minutes or so. You said something interesting, many things in fact, but I want to pinpoint just one. And you said the labour market was starting to flash yellow. When you hear from the Fed chair, he describes the labour market as being strong and a reason to get this right. You've said before that this Fed should be thinking about moving in July, not waiting until September. What is a couple of months between friends? Why do you think it is important to start getting going and getting moving earlier and sooner rather than later?
If I was as certain as the market is that he was going to move in September, I will tell you that a couple of months, there wasn't much in it. However, you have two factors that may complicate a September cut for this Fed. I want to stress for this Fed. One is they may get one bad data point. And then because they're so overly data dependent and they're not looking forward enough, that could postpone the first cut to November. And then you're starting to talk about a longer lag. The second issue is the politics, John. Is what does the politics look like when we get to September? And how worried are they that there's going to be an inflationary shock coming after the elections due to policies? So it's not as simple as saying, well, the market thinks it's over 80% probability is going to happen, because this Fed is very impacted by high frequency indicators.
Let's flip this on its head, because a number of guests have come on the show and said that the big fear for the Fed and the worst case outcome would be if they had to reverse course and hike rates again at some point in response to an inflationary shock. Do you think that that isn't that big of a risk, or it wouldn't be that problematic if they had to reverse course, say next year, after starting cutting either in July or September?
So I do agree it's their biggest fear. They don't want to be in any way resemble to the 1970s, and it is a huge fear. And they've already made two mistakes in the last 3 years. First, a transitory call that was horribly wrong, and then secondly, at the end of last quarter, they got too excited about what was happening on the inflation numbers, and they had to reverse their view. And we saw the amount of pivots. I've never seen so many pivots in forward guidance. The whole point of forward guidance is to provide smooth market adjustments. Instead, we've had this enormous number of pivots in the signals from the Fed. So I understand that hesitation, and I agree that this will be in the back of their mind. If they do have to hike next year, I think it's a low probability. But if they do have to hike, it is because something has happened, either externally, we've had a major shock somewhere, or the policies elsewhere, fiscal, trade, have fundamentally changed. And I think people will understand that, and they won't blame the Fed. They'll see that there's something else that has happened elsewhere. No one blamed the Bank of England when it had to respond to the Liz Truss moment. I don't want to say the US is going to have a Liz Truss moment. It will not. But people understand the credibility of an institution when the shock to inflation is coming from outside.
Mohammed, final question. Do you have more confidence, more faith in Chairman Powell's Federal Reserve or Gareth Southgate's England team?
Wow, that's a really, really tough question, John.
Team question here, yeah, okay. All right, so, yeah, I don't know. I think it's pretty unlikely. I think that we'll end up seeing some kind of hikes next year. But anyway, look at this. Services less trade, transportation, and warehousing. Less services, less trade came in at the same level as last month. But then you look at trade services right here, and they're at 0.6 versus 0 last month. And this is just the stage 3 right here. But if I'm just going to type into search trade services, it just is a little odd. Let's go to the bottom one. Yeah, see over here. This is stage 4, 1.2% inflation, and that's a 1.7 weight. The last one was like a 5 or 9% weight. This one, stage 4.2. Let's go up here. Oh, this is quite confusing. Trade services for intermediate demand, 18% of the weight. That was 0.5%, but that was actually lower than last month. Here, personal consumption, less food, energy, and trade, 0. That's like the headline number that we saw. Some Fugazi magic happening there, and some of this trade services number, the 19% weight right there, 1.9% increase. Yeah, so I don't fully, I don't trade internationally, so it's a little harder for me to understand what's going on, but it feels like it's mostly isolated to something weird going on in trade, not necessarily something that suggests U.S. consumer prices are going to roll over. But I don't know how markets are going to react to that. I just really don't want to see a continuation of yesterday. You know, yesterday was bad. The mega cap sell-off is something that leads to layoffs and would be very bad if it continued. I don't want to see that. Yeah, because you don't want to go into a recession. Nobody wants that. I know some people who are like, no, give me a recession. Yeah, you're not going to be saying that when you're in one.
After call logs were copied from a third-party platform hosted by Snowflake. Shares of Snowflake are lower on this news.
The June PPI coming in above, hotter than expected.
Now they're going to explain it finally?
Negative CPI print. Joining us now on the markets is Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's.
There's no way he already went through it.
Chief Economist at Wisdom Tree. Jeremy, Professor, it's good to see you. You said that we won't see a rotation into small stocks and value stocks until it becomes clear the Fed's going to cut, and that the CPI, you said this before it came out, could be a game changer. That's exactly what happened. You saw what happened with the Russell yesterday. Now, what is this? 3 steps forward, 2 steps back? What did the PPI say to you?
Well, I think it's 4 steps forward and maybe 1 step back. There's a few components here that do go into the PCE, and it's going to take a little while to suss that out. But I think that the CPI was a game changer. And yeah, I mean, it was last Friday for Scott Wapner closing bell that exactly what I said. And I think the Fed should definitely cut. I mean, not only was it great inflation news on the CPI, which is far more important than the PPI, but let's look at jobless claims. Now, jobless claims were good this week, but don't forget they reported.
Yeah, see, he's not talking about PPI because he hasn't read it yet. Bond yield's only up like 2 basis points on this. This isn't really a big move. Gold dropped like 81 bips for some reason. Silver down 272. But you know, Dow's up 3 basis points, S&P's up 2, NASDAQ. Well, here it says the Qs are up like 18 bips. Oh, okay, so you're just now rising, so that's just a little delayed right there. Yeah, the Qs are up like 18 bips right now, so, all right.
Cut. I'm just hoping that he'll cut fast enough that he won't go too slow on the way down, the way we know he went far too slow on the way up. So,
Matthew's just said, no, I didn't see her recent comment. So Roberto says it's called manipulation, Kevin. Seriously. I don't know.
You don't think before September?
no, unless we get a big deterioration. I mean, I'm trying to think that July 31st is the meeting. So we get maybe 1, 2 jobless claims, no other really important indicators. So, no, he's far too deliberate. But it'll be a tee-up, I think, you know, saying we now see the conditions in place for a cut if the data continue to move in the direction that we are seeing at the current time.
Right.
Of course, the cut is expected to be 25 basis points, but, you know, there's 6 weeks until that next meeting, and we'll see whether he is compelled to do more at that time. But that's my expectation for the July 31st meeting.
So not just inflation, but suddenly the what we're seeing in the
Slow down
labor
the economy,
market.
because it looks like this half is going at less than 2%.
Yep.
You know, we were originally excited about, you know, last year way above expectations. The Fed expected over 2% for 2024. Well, the first half looks like under 2%, and you know, that's below Fed target. So there's many reasons. He himself said, we're not going down to 2, waiting for the, you know, CPI to go down to 2 before we cut. That's far too late.
Oh, you just got 2 downgrades that came in on Tesla. UBS downgrades Tesla to sell, saying the stock has rallied too much. And was it 2 downgrades or 1? Because this implies Tesla got Wells Fargo and UBS, but let me see, that quote looks the same. I mean, it's not a surprise. Yeah, I don't actually see that update yet. Okay. Oh, yeah. UBS downgraded to sell. Price target of 197. Then I don't see the Wells Fargo upgrade. I only see UBS here. Yeah, no, it's just UBS. Okay, got it. It was just one downgrade. But that was already in the pre-market. Okay, so, yeah, I don't think this PPI report is that bad. I just don't understand how that trade component would actually flow through to CPI. So, and this guy's not talking about it, so I'm going to flip. Probably because he just wanted to talk about CPI and blow off PPI.
Underlying a lot of the job market data has been this gradual rise in the unemployment rate. But I think the biggest concern that we have about the job market is just the continued narrowing of where job gains are coming from.
Yeah, freight rates, you're right. Freight rates have moved up quite a bit. A lot of that can be traced back to the Red Sea disaster that we have. You know, the fact that we still don't have control of the Red Sea drives me nuts. Yeah, we're only up 1 basis point on the 10-year right now, so yields aren't really moving on this. This is weird. Okay. Okay. Let me see here. I think we have bank earnings start this morning too. So let me see if JPM came in yet. Everybody wants to pay attention to CPI or PPI right now, which makes sense. But I'm gonna grab bank earnings now. Let's see. Are they out yet? I think they are. Okay, let me look at JPM. And let's see what their stock actually did. They're down about 17 basis points. So Allowance for credit losses moved up to $3.05 billion. The expectation was 2.83, so a little bit of a move up there. Deposits came in a little lower than expected at 2.4 trillion versus 2.43. Investment banking revenue came in well higher than expected, 2.46 versus 2.13. There's been some progress from bringing inflation down. Still multiple inflationary forces. Inflation and rates may stay higher than the market expects. Did not fully expect or don't fully know the effects of quantitative tightening. Okay. Half of card reserve build is tied to macro updates. Robust M&A, mergers and acquisitions. Economy seems to be on trend for a soft landing. Want to be a little cautious on the outlook. It sounds pretty generic. It doesn't sound like poo-poo doo-poo's hitting the fan yet.
The Republican National Convention coming up next week. Another key interview as well, Anne-Marie, for the President of the United States on Monday.
That's right. He'll be sitting down with Lester Holt of NBC Monday in Austin, Texas. Today, he's going to be in Detroit, Michigan. He wants to make sure that he can sell his campaign to not just the American people, but the Democratic Party. 17 Democratic lawmakers have now come out and said he needs to step aside as the nominee. Politico put it this morning, really fantastic, saying Dems are living in purgatory now. Yesterday, didn't do enough to assuage their concerns about President Biden, that performance, the fact that these gaffes completely overshadowed the policy and the substance and what we should have been talking about. Your point, Jonathan, earlier was right on target. There are two hot wars happening in the United States, and yet everyone in the room was wondering about President Biden's bedtime. They're worried about his health. Can he do this another 3-4 years? Can he go sit across the table of autocrats like Xi Jinping, Vladimir Putin? But yesterday, was it so bad the game is over for him? No. So he's still fighting his political life. So next week is going to be entirely focused on Biden, maybe potentially until we get to the RNC and we find out from President Trump, former president, who his VP pick is.
Lisa, this is the presidency. This is not just about the campaign. This is about serving as the President of the United States. This ridiculous game about whether we can get through an interview or a news conference, when are we going to stop playing this?
Well, a lot of people have been treating this like I don't know.
Well, I think we're going to stop worrying about our president when we need to stop worrying about our president. I don't know why all of a sudden they're so, like, angrily defensive of Biden here. That was a little weird. There's, like serious anger there about, when are we going to talk about policy? It's like, we have a senile president. Good Lord. How dare Americans be concerned? Anyway. Citi says consumer loan loss rates are picking up. Customers are being more discerning on spending, and more credit card spending is coming from largely the higher credit score consumers. Yeah, I mean, it's not a surprise. Consumers are resilient but cautious with spending, is the argument now. Very interesting. All right.
Are the pro version. And so it's really giving impetus, not just for the typical cadence of upgrades where the install base is really aged, but also for the newer phone users beyond sort of just before the 15, the 14s and the 13s to actually upgrade a little bit more atypically. So there's a cyclical benefit and a component over here that we're picking up in our survey work, which I think is really interesting to drive upside to both 24 and 25 iPhones.
So do you think that people will choose, if I'm at 11 right now, obviously I'm not really focused on the latest and greatest technologies because I'm willing to live with the phone that I have. But are you getting the sense that people are willing to trade to the highest level to get that AI upgrade? Because I think that changes the cadence, right, of how much revenue you actually build in because of this upgrade cycle.
Yeah, absolutely. The mix is going to be super important. Most of the real interesting thing about the mix is that there is this misconception that the Pro and the Pro Max are only relevant in developed markets and emerging markets. They tend to gravitate to the lower versions of the phones. Our conversations with the company and our own survey work shows that the Pro and Pro Max have been gaining share ever since 2021, right? So from COVID levels, when people were guessing that, this is all because of stimulus checks, that mix is sustained to be very, very strong now. 3 years post that, right? So it shows that people want the feature functionality. And so the more you offer them at the higher end, the more you're going to get that mix shift continue to be a positive driver for Apple. We actually think that there is a possibility that Apple introduces an ultra model going into next year, so at the iPhone 17, which would be even higher than the Pro Max level. And that could be, in generative.
That's an interesting thesis, this idea that they basically try to really squeeze every penny out of that AI. It wouldn't surprise, I would not put it past Apple to do that. I kind of think they're really excited about making as much as they can in profits from the AI. I'm saying that on purpose. Mostly because there are going to be people who pay for it.
Check on the markets. The NASDAQ is getting back now. Some of those losses from yesterday. Now the Dow actually as well. Actually, I was looking at the futures themselves. Just a little bit for the NASDAQ. Dow is now turned higher. After all those bank earnings, was that the highlight?
Wells is still down 5%.
Was that the highlight of your day, did you say? Or just being here?
Being here.
And the banks.
With the banks. What a combination.
It was a slice. It was a real slice.
Electrifying.
Yeah, when are you back? Not for a while.
Not for the foreseeable future. Have a great weekend.
Squawk on the Street is next.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, Sarah Eisen, and Post 9 of the New York Stock Exchange. Kramer has the morning off. Futures pretty solid as we watch for signals as to whether yesterday's rotation was the real deal. Bank earnings in focus. PPI does come in a tad warm. Yields still lower at the short end, 2-year below 4.5.
I'm really surprised I still haven't seen anybody actually explain what's in the PPI. Why am I the only one that it feels like who's talking about this trade services stuff? I've been looking. Somebody please help me understand this. I read the report, I'm like,
Let's begin with some market reaction to the banks today. Interesting split in the action, Sarah, at least price-wise, between, say, Citi and Wells on their results.
Well, also just the higher rates picture is affecting these banks differently. We always look at the net interest income, and it was a big miss on Wells, and that's partially potentially why the stock is getting punished today. We're going to talk to the CFO of Wells Fargo on money movers, but the 9% decline in net interest income, David, the fact that they don't appear to be making as much progress on the expense side, which was the bull case in part for the stock, that's certainly two of the knocks against Wells Fargo that I'm seeing this morning. But you don't see, for JP Morgan, that net interest income number was a slight beat. And they reiterated guidance. So I think there's a question now of how rates settle now that we're expecting 2 cuts from the Fed, and whether we've seen the bulk of the gains that the banks have made profitability-wise from these higher interest rates.
Yeah, JP Morgan, as you say, a different story. As you take a look, the stock is not doing much. It's perhaps going to be down. They got they posted a 20% return on tangible common equity. Bigger than expected buyback as well. The strength there was capital markets, wealth management, and cards. There were sort of trends in loans and deposits a bit flattish in terms of guidance. NII, to what Sarah's been talking about, came in more or less as expected. But generally seen as a very positive quarter for JPM. Nonetheless, as you can see, the stock really doesn't seem to be reacting. Although quite a difference from the last quarter, we should point out, when the stock was down sharply on earnings. As you point out, Wells Fargo, I think there are a lot of investors, though, who are still lined up there for what is yet to come in terms
I gotta get my cup of coffee. I'll be back.
Around that's taken place under Charlie Scharf, although this is not a quarter, I guess, that's going to particularly excite them, Sarah.
When the asset cap will be lifted, which we don't know, and we ask every quarter, and they don't know, and the Fed doesn't know, and nobody's telling us anything like that. So that's potentially the part of the problem. The other thing I just noted in the JP Morgan quarter is that the credit loss provisions were a little bit higher than expected. There was a $3 billion build, $3.1 billion of credit costs, which was higher than anticipated. They had an $800 million incremental reserve bid. So that's always something to watch as we wonder sort of where we are in the credit cycle and how what these banks are seeing ahead. The commentary from Jamie Dimon continues to sound a bit cautious, even in the face of good news. I mean, it came right up top in his statement in the release where he said there's been progress of inflation, but he's still worried about it. While market valuations and credit spreads seem to reflect a rather benign economic outlook, we continue to be vigilant about potential tail risks. There's been some progress in bringing down inflation. This is what I was talking about, but there are still multiple inflationary forces in front of us. Large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. Therefore, inflation and interest rates may stay higher than the market expects. These bankers continually warn about this.
Unfortunately, the statement's all we have because he was not on the call because of a travel conflict. We did get the CFO, Jeremy Barnum, saying U.S. consumer is fine. There's some elevated dialogue regarding M&A, although regulatory pressures continue. I think we have some sound from the call. Take a listen.
When you look at the system as a whole, just to go through it, QT is still a bit of a headwind. Loan growth is modest and not enough to offset that. And RRP seems to have settled in roughly at its current levels, and there are reasons to believe that it might not go down that much more, although that could always change and that could supply extra reserves into the system. But on balance, net across all those various effects, we still think that there are net headwinds to deposit balances. So when we think of our balance outlook, we see it as flat to slightly down maybe, with our sort of market share and growth ambitions offsetting those system-wide headwinds.
Meantime, assets under investment management up 14, record number of first-time investors. And the Citi, or the Wells commentary as well, the percentage of investors who are moving into higher yielding instruments has slowed. Pretty interesting. And then credit performance is in line with our expectations. That was the word over at Wells.
Yeah, moving cash into it. One bright spot, David, in all of them consistently is investment banking fees, right? They soared. Citi's investment banking revenue I saw up 60% from a year ago. Now it was lower base maybe, but Wells Fargo fees up 38% from 2023. But slipping from the previous quarter, I guess, is another trend, but way up year over year, as you've seen activity come back.
There has been more activity, more capital markets activity for certain. M&A not as much in terms of advisory as perhaps there had been a hope for when this year began, and things seem to be perhaps on a holding pattern ahead of the election. You're the most recent person here who interviewed Jane Fraser, I think, Sarah. So I'd come to you on Citi, which, as you see, is
okay. I'm back. Let's do that. There we go. Okay, so yeah, this is really interesting. So still not seeing anybody really break down PPI. I did get a little bit. And it was an indicator that PPI right now is moving in a way that's like the core components of it are consistent with a core PCE inflation read of 0.16. And that's because what they're doing is they're calculating the CPI numbers that we can grab from yesterday's reports and the PPI numbers that we can grab from this report, merge them together and try to calculate a PCE report. So that's good. And it's probably because trade doesn't show up, at least as far as I'm aware, in the personal consumption expenditures read. So I think that's why you're seeing, even though there are a lot of sort of headlines about, the PPI comes in hotter than expected, blah, blah, blah. When you actually go into the details, this isn't bad. This isn't bad at all. So then the question just today becomes, okay, is this a rotation that is going to continue? Hopefully that's all it is. Or is there sort of a broader or more underlying issue that people have with valuation? See, one thing I saw was, here, I want to show you this. This was a great one. So, take a peek here. And this was interesting. This suggested the average stock involved in the infrastructure build-out for artificial intelligence has returned 26% year to date. but stocks with actual like AI revenues fell 19% between February and May. Goldman says investors are increasingly concerned about the potential returns to the hyperscalers' AI investment. Now, this is something that I've been yapping about for a very long time. This idea that we're spending so much money on these chips that until if people don't start making money, these chips are going to crash in value. And it's one of the reasons I think Amazon and Tesla sort of delayed their acceptance of more H100s or postponed it. Oh, finally. Are you serious? 39 minutes later? The details in the PPI report suggest that the larger than expected increase in June was mostly driven by an outsized jump in trade services. Thank you. 39 minutes later, finally I see an institution talking about it being trade services. We were concerned about that within the first 3 minutes of when it came out. So, okay. All right. That could be good, right? Because if you finally get coverage over this, you can hopefully quell some of that. So I thought this was interesting. Similarities between the current melt-up and the late 1990s. This wasn't great. This was the S&P 500 Information and Technology and Communication Services sector market cap versus earnings. And basically it shows you when are earnings sort of escaping, or sort of market cap escaping earnings. And when you have that sort of escape, the blue line goes up much more rapidly. And we're at the highest level that we've seen here since 2000, March of 2000, which is interesting. Then they also suggest when the 3-month Treasury bill caps out, you usually have a crash. So you had this crash in the .com era when the 3-month Treasury moved up, or down rather. The red line there being the 52-week moving average. 2007, 2018, and now they're going, question mark, basically. So that wasn't that was a little bearish. I didn't like that one. And then this was interesting too. They talk about in 2023, 97% of NVIDIA's revenue was driven by greater earnings. Just 3% of the was responsible for valuation 3% of their stock increase was due to valuation expansion. However, in 2024, 56% accounted for the year-to-date return. So massive valuation expansion. And this is despite the fact that we expect NVIDIA's growth to slow down substantially. Those are sort of here's the chart of the estimates. Something else that I've been complaining about, that it'll average to 10 to 20% over the next 4 years. And the slower it is, the higher the valuation actually really is. See, a lot of people, they use pegs. And the problem is they're using the trailing data instead of the forward-looking data. I personally think that's a problem because what you're doing is you're justifying and rationalizing past valuations, and you're not trying to understand where we're going. It's like being on a train looking backwards. I thought this was interesting too. I really like this piece, the marketeer put together. I thought it was a really good send out. But anyway, they say here, at CNBC in a prior career, I covered an upstart health plan that really believed that tech, specifically machine learning / AI, would be the core lever to drive behavioral change for its Medicare population. In other words, yeah, we're going to use AI in Medicare and change the world. Yeah! That would improve outcomes and drive costs lower. They hired a whole data science and engineering team with the thesis, raised tens of millions of dollars from tech VCs, spoke with employees some years later who were all looking for alternative roles at software companies. Can you guess what the most effective intervention was for Medicare patients? The most effective artificial intelligence was a nurse visiting their home. Nothing else compared. Dang, that was deep. It also kind of hurts because it's like a loneliness problem, Now, Deloitte is all in on this AI. They're I was just reading this piece from Deloitte yesterday. And Deloitte's like, oh, underwriting at insurance can increase productivity by 113% using Gen AI. Investment banking, 27% increase in productivity. Boy, these people must not be able to work hard. Just kidding. But it seems, some of these seem like a little lofty. I do think underwriting would be useful. Loan underwriting would be useful. Reduced credit card delinquency by 32%. Reduced fraud by 6%. I believe some of those aspects make sense to me. I don't know about this. 27 to 35% front office employee productivity increase. Oh, they're saying by 2026. Oh, now they're trying to forecast. Okay, yeah, I was gonna say there's no way we have that kind of productivity increase today. But all right, interesting. Very, very, very interesting pieces.
How do we read into that, and what is it going to mean for the averages and the pain out there, despite the fact that everybody's been rooting for small caps and for this broadening out?
I mean, the Mag 7 has added some $2 trillion, some incredible number in market cap, and that to some extent has sucked the liquidity out of the rest of the market, essentially.
When we come back, Tesla's 11-day win streak comes to an end. Stock gets slapped with a sell rating over at UBS today. We'll talk about this reported delay in the robotaxi event on August 8th. As futures hang in there on this Friday, what an eventful week. Stay with us.
Yes. Let's change this way.
Based on a comparison of Bank of Japan accounts and money broker forecasts. The exit of Wall Street's last bear, Marko Kolanovic at JP Morgan, reminds many of a similar departure before the dot-com bubble burst. Now, if they're wondering if the whole saga is a sign of the market peaking, the fear is history is about to repeat itself, as the erasure of cynics is something that typically happens toward the end of market manias. President Biden downplaying concerns about his presidential campaign, but a series of high-profile gaffes during the NATO summit yesterday renewed concerns about his age and acuity threatening his presidential status.
I'm determined on running, but I think it's important that I allay fears by let them see me out there. Let me see them out. You know, for the longest time it was, you know, Biden's not prepared to sit with us unscripted. Biden's not prepared to, anyway.
And Julian Emanuel of Evercore ISI still with us. And Julian, I guess we'll start there, and it's political risk. And I'm not going to ask you Biden versus Trump, but if you were going to invest on themes that come out of the election, when is the time to put on that trade? Some have suggested August, for example, but how are you thinking about it?
This cycle is very different, okay, because the volatility around, the candidates, the news cycle, the conventions, all of that make this really, really unique. Look, the fact is a lot of what we would call, quote unquote, the Trump-related themes have worked in recent weeks, and it's not a coincidence, as if you look at the polling and predicted and so on, the probability of his winning has risen. But there's also this thing that, you tend to get sort of a peak in enthusiasm and interest once the convention is over. So I think it's one of those things that we're probably better off picking stocks, identifying things that we think are going to work under either administration. And, if you want to be tactical, there is a potential for that.
There's no themes. There's no Trump 2.0 themes that you can invest in. I mean, with big tariffs, with probably, I guess, the completion of the wall, with Mexico footing the bill this time. Isn't there anything you can do that you can pull out of that makes for a good 4-year investment?
Look, there are, and frankly, you talk to our energy analysts, and obviously it's pretty clear that energy is likely, traditional energy is likely to do better under a Trump administration. But a lot of it isn't quite as clear. Conversely, you talk to our semis analysts, and frankly, politics may not play all that big a role, even though you would think intuitively, based on our relationship in China, that it would.
It's really interesting to see the divergence in how investors are really baking this possibility. Yesterday, we spoke to Steve Eisman over at Neuberger Berman. Let's take a quick listen about how he really weighed the benefits of trades versus investing in this environment.
100% certainty Donald Trump wins.
Interesting.
Really?
100%
Is that
certainty.
investable, though? What do you do?
Well, let's talk about why.
Yes.
So forget about, whether Biden's going to run. It doesn't matter at this point, to me, whether Biden drops out or does not drop out.
So he went on to talk about how the banks, for example,
This is a pretty certain individual there.
I'm going to step back for a moment, and the concept, particularly when we look at the markets of the last 4 or 5 years, the concept of something being 100% certain is very frightening.
We
to
did
us.
question him repeatedly about that.
As you got my title, we have derivatives in our title, we have quant in our title, and then basically, that tells you that 100% certainty is not something that markets typically tend to deal with. Again, there's been an enormous amount of noise in and around this, and let's face it, it's not even Labor Day. The amount of noise is going to get bigger. We were all glued to our TVs last night. We will continue to be glued to how this evolves. So to us, again, what it likely is that you get these times where emotion takes over, and that's where you get dislocations, and that's actually part of the recipe for, in a market that's in general very highly valued, you're still able to buy things low. And that's the kind of thing we're trying to do.
Well, speaking of 100% certainty and high conviction, let's talk about the state of forecasting. Obviously, your 6,000 call made a lot of waves, but it was interesting to see, for example, you had Michael Kantrowitz of Piper Sandler backing away from the practice of S&P 500 forecasting. And I'm just wondering how you're thinking about the state of your industry. Do you foresee more people, and perhaps yourself included, backing away from that practice?
We're not going to back away from a price target. It's just, it is, whether it's, a strict discipline or what it is, but it is one of the things that frames the ability to talk about markets in general, again, against the backdrop of there is no such thing as 100% certainty. Everyone knows that, it involves a range of outcomes, a particular path on the road. And frankly, for us, as you know, we revised our price target up drastically several weeks ago when we came to the conclusion that looking at the past, expensive markets, and this inexpensive market, tend to actually go on for longer and run further. So it's an uncomfortable reality, but again, it's our conviction.
Bull markets last about 5 years on average, right? And we're only 19 months into this one. We're up 50%, and typically bull markets would double that. I want to ask about buying low, because you said you still can. And you have this concept of valuation convexity for people who don't trade in options. Explain that to us, because you can definitely buy high in this market.
Yeah, no. So when you look at the quant factors, one of the sort of the head scratchers about the first 6 months of the year is that for the most part, valuation, as in buying lower PE stocks versus sort of using higher PE stocks as a source of funds, has not worked. And if you think about it,
but wait, so you sell like a Tesla, and then you buy something that's
the home
like
builders,
a Toll Brothers.
The home builders, for example, are and think about what we've seen in the last few days is the market is validating this idea where interest rates may not fall, but they're clearly capped to the upside. That's good for something like a home builder.
All right, Julian, unfortunately, we're running up against the clock. Got to leave it there. Hope to see you again soon. Our thanks, of course, to Julian Emmanuel.
Okay, so a little bit more on the PPI. Interesting, this idea about the home builders. But anyway, of the 0.566% increase in services, 0.552 of that was due to final demand trade services. And that's on the, let's see here. That's on the month-over-month figure, I'm pretty sure here. Yeah, the other number, that adds up, right? Yeah, let me make sure. Hold on. So, PPI, final demand year over year. Oh, it might be the year over year figure. because year over year was 2.6. And so of that 0.566% increase in services, 0.552, so almost all of it was due to final demand trade services. And that's an interesting one because that is a measure of margins. Like basically how much money are these either trade brokers or wholesalers or whatever, how much money are they making? So like this is really kind of complicated and arcane, but I'm going to try. If I'm going to buy this plate, like let's say you're throwing a wedding and you're like, hey, I need 1,000 of these plastic plates. You're not going to call a manufacturer in China. You're going to call some dude who wholesales plates. And that dude who wholesales plates is going to call their buddies in China, and they'll ship them over. Okay, so measuring an increase in final demand services would be you called me up for plates, and I was able to make 50 cents a profit per plate as opposed to, let's say, 40 cents a profit by, buying it from the manufacturer and then giving it to you. So maybe I buy it from the manufacturer at 10 cents and I sell you each plate at 60 cents. So, it is a type of inflation. There's no doubt about that. The question is, how does that show up in consumer prices? I don't know. See, because even if, let's say, Target was buying those plates and they had to pay more, their margins could get hit because you have a consumer that's not willing to pay more. So, yeah, I don't see this report as a horribly big deal, but I'm gonna kind of brush that one aside based on the analysis that we've done. Hopefully that's helpful. It's a little kooky, But anyway, let's listen in here.
And follow the Squawk on the Street Opening Bell podcast.
What? Opening Bell podcast. Somebody here says, Kevin talking about plates. I'm sitting here eating off my lap with a napkin. Hell yeah. Hope you're wearing pants. Cutting out the middleman is recessionary. Well, this is the opposite of cutting out the middleman. This is paying the middleman more. Oh, yeah. Does Kevin's scalper swing? Lately, it's been swing. So I've been a little bit more into swinging. Boy, outside the concept of like trading, that doesn't sound good. After the last 8 years, I believe Dems say Republicans are doing what Dems actually don't believe Russia is getting in. I don't know what you're saying there, Bob. I don't believe Russia is getting in to help Trump. Oh, I see what you're saying. Yeah. I have 20K. Can House Hack help me bring in passive income? Hopefully someday in the future, but not now. Does Kevin cold plunge? No. Lost money yesterday. How do I tell my wife? You bring her a Mai Tai. Yeah, yesterday was crazy. Because you had like insane profits that in the span of like 5 minutes crashed. It was insane. I mean, look at let's look at AMD yesterday. There. Right there. Look at that. That's what you had. That was insane. Yeah, that was pretty painful. I got hit on that too. It was like 9 minutes. It was like a 9 yeah, it was a 9-minute crash. 9 minutes. Boom. You literally went from 133 to 130, which that's a substantial move. If you're in on options. And we did end up breaking that downtrend, the rapidity of that downtrend, but you still ended up bleeding into the close. It was crazy. Absolutely crazy. Yeah. That's wild. So, and then the Qs, you know, yesterday bled down as well, obviously. IWM's doing well, which yesterday in the course member live stream, we put together a spreadsheet of the relative valuations of the various different small caps that we were looking at. I thought that was kind of useful. We'll probably look at that a little bit more today. Oh, Apple's rising into the open here. So, nice little move on Apple. All right, let's, oh, we're already 1 minute away from the bell. That's crazy. All right, let's see what happens at the open. Dun, dun, dun.
Nearly all of AT&T cellular customers from May 1st, 2022 to October 31st, 2022. These are phone call and text message records of all of those customers. The records identify the phone numbers with which an AT&T number interacted during the period. They do include AT&T landline if you still have one, a home phone. Also, of course, included counts of those calls. That said, it doesn't include the content of any of the calls or texts. It doesn't have the timestamps. It doesn't have any details such as social security numbers, dates of birth, other personally identifiable information. It's AT&T shares. It's also the third-party platform. That's Snowflake, guys. We'll get to that in a moment.
Let's get the opening bell here in the CNBC Real-Time Exchange. And the big board, it's the 99ers. Deanna Scurry, Michelle Akers from the 1999 U.S. Women's National Soccer Team doing the honors at the NASDAQ. Ingredient supplier Above Food celebrating a recent listing via SPAC. As we're back within a few points of 5,600. And we'll keep our eye, I guess, Sarah, on the
All right. Let's see what we got going on here. We've got some movers and shakers going on here. We've got, looks like Tesla's trying to keep on to that 2.2-ish% red. I don't know. Is it going to hold? You've got NVIDIA rotating down a little bit here. You've got... yeah, NVIDIA's trying to come back a little bit there. Okay, all right, let's see here. Oh, there goes NVIDIA. Nice. Good move on NVIDIA. And NVIDIA's trying to come back to the top there. Let's see, then you've got Tesla trying to come back to the top a little bit as well. You've got the Qs. Qs here, yeah, up about 20 basis points. Nice move. Tesla's down about 2%. It's actually not that bad. You know, in the pre-market yesterday or the post-market, you had a lot more of a movement there on Tesla to the downside. It was down somewhere like 3.9%. Not great. So definitely some oopsies there. And looks like, yeah, Tesla's kind of picking up a little bit of pain right there. And what do we got here? The Qs trying to red candle a bit. Red candle there on NVIDIA. Big red candle there on Tesla. Not great at all. But the Qs are really holding up. So this is actually a fortunate thing that you're not getting like a big sort of day two set of pain on the Qs. It just seems like you're getting a little bit of a day two pain on Tesla right now. I don't know how long that'll last, but you're getting a little bit of that oopsies over here. So, yeah, look at that. Now you're down about 3.06, 3.1%. NVIDIA recovered, and now we're waiting to see what Tesla ends up doing. It wants to, oh, look at that. Yeah, yep, there it is. It's trying to stabilize there somewhere around, looks like, what do we got here? Stabilizing around 2.8? It's too hard to say that it's actually stable at all. Seems like it's just having a rough day. And, yeah, it's coming back up. Is it? Can it? Yeah, it looks like you just had a rough candle there for a moment. And now you've yep, nope. Ouch. Ouchie wouchies. So anyway, and then NVIDIA's down about 0.5% over there. Okay. And then the Qs do look like, oh, the Qs are now coming down a little bit too. Okay, wow. That's very interesting. So let's see here. Qs, yeah, about 10 bips. I thought I saw Apple running here. Yeah, Apple's running. Apple's trying to push up. That's going to lead the Qs to move up over here. And then Enphase broke the 113 line. Back to what we saw yesterday. You know, in the pain yesterday, it was at 113, and then it went down to like 110 or so. Let's listen in over here for a moment.
It's up 3% this year and has been underperforming and is getting a little bit of a boost because they did okay. The read was okay. It wasn't all that robust as far as what's going on in the industrial part of the economy. And look, there are reasons to be hopeful if you do get interest rate cuts. And I think the next debate is going to be that we're going to have, okay, September, December look to be baked in. Hopefully Powell will hint at them. And then what? Where does the path of rates go? What is neutral? Where do they want to land? Are we talking about rate cuts at every meeting? Are we talking about every quarter? And there's no real consensus on this from Wall Street. I mean, some economists think it's every meeting. Some think that it's every few meetings. Some things they're just going to pause afterwards.
Well, that's why, I mean, you tell me because you just talked to him, but when Powell folded in not just the timing of the first cut, but not cutting enough does pose risks to economic activity.
He would not go there on the path, just like Christine Lagarde won't go there. And the reason is because they don't know. Because they want to see how the economy responds, and they want to make sure that they don't flare up inflation and financial conditions get super loose again, and that puts price pressures and takes away some of the progress. They just don't know. And they don't know where that neutral rate, where they need to land, is. If it's higher now in this economy, the neutral rate is...
Larger red candle there on the Qs. Really trying to watch broadly what's going on here, because again, you hope that this is just a rotation. That's what everybody wants to hope for. You know, it's Etsy, it's a firm, 1.8%. Okay, great. Enphase, I mean, great moves on Enphase here, right? You've got ARM, you've got Uber. You know, I'm actually surprised Uber's down, because yesterday they were really starting to run because of what you saw with Tesla and the delays over at Tesla. Tesla was down as much as 3%. It's presently down about 1.9%. And the Qs, there we go. You're getting those red candles, but you're mostly bobbing around positive here, 14, 15 basis points or so. Apple stopped running. Ah, man. The Qs keep trying to go red. I sent an alert to all of those of you in the Stocks and Psych group. Yeah, I'm very curious to see how this develops here. So, big red candle there again on Enphase, but this one's always volatile. Tesla's trying to recover here. Nice, look at that. Now it's above where it was at the open. There you go. Okay, so getting that Tesla recovery. BTC, oh, still sitting at our line. It's crazy. ARM's positive by 2%. It's pretty good for the megas right here, you know, for the big boys. Palantir's down a little, Snowflake down 3. Oh, that's right, there was some Snowflake news. Snowflake, let's see here. News. Yeah, nice run there. Let's see here. Snowflake, AT&T hack suggests more customers affected. And someone inside sold some shares. Price target cut at Piper Sandler. Snowflake shares drop 2.5% after AT&T hack disclosure. I don't fully know what's going on with that, but it could be a short-term oopsie-doopsies.
Reports that we've gotten, you might anticipate that would follow through in some of those results, and both those stocks are up. Bank America also down, as again you might imagine, even though we haven't heard from that company.
It's a net interest income story, and that was the weak spot in the Wells Fargo note. Although in the Wells Fargo report, I would just note though the bank, the financial sector is still up almost 2% this week because it has been a beneficiary of this so-called rotation. And just to put it into context, I know we've been talking about all morning just the violent sort of change in the market toward the small caps and away from the tech stocks. The Bank of America does their flow show where they put out the flows in the last week, and the flows in large cap growth at its highest versus small cap value since 2000. So that was the backdrop we were coming off of. Just so much money had been moving into these large cap growth tech stocks and away from small cap value. Perhaps one of the explanations, well, no doubt one of the explanations for why this move was so violent that we saw yesterday. Question is, does it continue?
Yeah.
We talked to Jim yesterday, David, about whether or not the banks were going to start to demonstrate cost efficiencies because of AI.
Yeah.
They're widely considered the sector that will, in the end, benefit the most. But we're not getting that yet. If anything, the expense guidance is going the wrong way on names like Wells and Citi.
Yeah, I mean, it would seem to be a bit early to anticipate or at least expect that to be coming through on the income statement. But Jim did make the point of how many chips JP Morgan has ordered from the likes of NVIDIA, how much time Jamie Dimon has spent with Jensen Huang, how many computer scientists they have at the bank, for example. All of which, when he did his, I think he did something on Mad Money this week, the idea of what will be in the $1 trillion club in the future. JP Morgan was an outlier, but one he thought perhaps could.
Tesla is recovering almost fully right now. So Apple, really nice recovery, which sort of like argues that, is there actually a rotation away from the megas, right? I mean, Tesla had bad news yesterday, so you kind of have to like separate Tesla from the pack. But Tesla's already recovering. So, you don't want to look at Tesla as a macro indicator because it's not, A. And B, when it has an idiosyncratic problem that comes up. But I'm still curious about the Q's barcoding. I really think this is an interesting one. So, watching the Qs, watching NVIDIA, which is somewhat sideways here. Tesla is really trying to recover here. I mean, there's some real buy the dip happening here on Tesla. And yeah, it's about to go green. That's pretty incredible. Then you've got ARM is up 3%. Crazy. FICO's up another 25 basis points. Carvana. Open Door is up 11% today. Should be closed door. But let's see what they've got. Let's see if there's news on Open Door. Nope. Just social media volume. Oh, yeah, I mean, hey, well, if there's volume, you can trade. There you go, Tesla. Look at that.
Gain the lead.
That's great. And that's kicking butt. Well, let's listen in over here.
But Barnum said he's hopeful they could be seeing a better trend here with elevated dialogue within clients, but some caveats as well. Those include the pull forward effects, particularly in debt capital markets, and that encompasses a lot of refinancings in the first half of the year as the IPO market does still remain pretty dormant. On the net interest income side, Barnum said quantitative tightening remains a headwind and loan demand is modest and not enough to offset those forces. Barnum also added that there are, quote, net headwinds to deposit balances, although he says they see their market share and growth ambitions support those macro forces. Barnum said it's too early to call for the end of over-earning of that kind of narrative we've seen over the last few years in terms of the importance of net interest income in a higher interest rate environments because of the murkiness around what exactly the Fed will do from here. Worth noting, guys, as you mentioned, Chairman and CEO Jamie Dimon was not on today's analyst or media call. He had a travel conflict. I believe he is in Germany. So we didn't hear from Dimon on the
Deutschland.
From him in terms of the statement. Some of the same concerns and conservatism surrounding geopolitics, the potential for inflation to come back again due to the deficit and due to things like the deficit and the spending, the fiscal spending that we're seeing from the government.
Leslie, what do we have up next call-wise? Wells Fargo and then
Wells Fargo?
Citi?
Yep, that's correct. Just checking my schedule here. We have Wells Fargo at 10 a.m. for the analyst call, Citi at 11. And I know Sarah is sitting down with the Wells Fargo CFO in the 11, and then I'll be sitting down with the Citi CFO this afternoon in the 1 p.m. So we should be getting a lot more color on the macro environment, on what's going on with net interest income and some key drivers there. We heard, I was listening in on the media call for Wells Fargo, and they kind of alluded to the fact that they would discuss a lot of the drivers for NII on the analyst call. There were a lot of questions.
It's net interest income that fell over at Wells Fargo. Quite a bit. Okay, red candle there on the Qs. Nvidia's falling. It's up. It's only up about 20 basis points right now. Big red candlestick there. Tesla keeps rising, so you're up almost 1%. And let's see. IWM's up about 1.2%. That's your Russell 2000 small cap. So again, hopefully that is just some form of a rotation, but we're only about 14 minutes into trade here, and Nvidia's going oopsies here for some reason.
For that division. And then on the cost side, we actually saw some tailwinds there for just overall expenses that were able to offset some of the other costs, especially the fines that took place from the Fed and the OCC earlier this week related to internal controls and their management of data.
Let's flip around that. I think they were talking about Evolve, by the way.
AI plans. Remember, Tesla also pushed back its planned robo-taxi unveiling to October. You can see shares rebounding a little bit, though, after yesterday. Next up, we have BMO Capital Markets raising its price target on Microsoft to $500. The analyst cites rising cloud expectations, shares down mildly. And finally, we have JP Morgan lowering its price target on Estee Lauder to $129. Now, the cosmetics giant announcing earlier this week its CFO will retire. And the stock, it's been under pressure thanks to weak demand in duty-free shops in Asia, Matt.
All right, always interesting, that Estee Lauder story. Let's get, though, to politics.
Okay, yeah, NVIDIA just went red. I'm really struggling to see, like, I haven't really done anything because I've just been watching this. Because I'm like, okay, Apple's capping out. The Qs were barcoding, and now they're falling. Yeah, Tesla had a surge here. Now we've got a red candle. Let's just, 1 minute though. Who cares? There's an attempted NVIDIA bounce. It just went red for a moment there. And Apple's now rotating down. JPM's down 1%, but it's rising. Qs are trying to come back. Tesla's up about 0.6. And now Enphase is falling. Affirm's falling. ARM's still up 3.5%, which is crazy. It's at $180. My lord. And Trade Desk. What are we at? Under 98 bucks here. Amazon. No big movers here. Let's see here. Open Door gave up a little bit. QuantumScape's still moving. Solar Edge. Nice move on Solar Edge. Although they're coming down a little bit right now. You've got Snowflake. Is only down 2.5. Meta's down a little bit. And sort of by market cap. About 50-50 on the large, and probably more like a 90% green on the smallers over here. This is very much that rotation thesis that folks talk about. Tesla's back to about 1%, although it seems like you're topping here. I wonder what are you getting rejected at here? I don't have a... Oh, I realized yesterday my line here on Tesla got deleted. Somebody remember what this line was? I'm sure I have it in a screenshot I've posted somewhere, but I accidentally grabbed it and I'm like, crap, and I dragged it along. Oh yeah, I did. I posted a screenshot of my lines yesterday. Did I? Oh yeah, I don't wait. I'll have to play with that. I thought there was one here in the 140s. I screwed up one of my lines. I hate it when that happens. I gotta lock them. Oh well. So yeah. So anyway, look at this. Now you get this a lot in Tesla, this sort of volatility. So this isn't like horribly unusual. Okay. All right. No, we'll keep an eye on it. Let's see what else here. Let's jump in. Yep, there it is. Okay. Well, I don't see this continuation of a mega cap sell-off that you had yesterday. Yeah, okay, we got a red candle there on Apple. You know, Apple's moving down, JPM's moving down. Nvidia's just trying to move sideways, but it's up 80 bips, you know. The Qs are actually rising here. So it doesn't seem like that fear is continuing from yesterday. Obviously, some of the morning euphoria is going away. That's okay. Some people wake up and they're excited, and then that excitement goes away. You know, that's, I suppose, very normal. Yeah, Tesla is consolidating a little bit over here. Let's see if it can break out of this little range it's in. It's been in for about 5 minutes. Okay, Apple's trying to come back. Yeah, there go the Qs. Yeah, this could be okay. You know, that you're not seeing this massive increase in pain that you had going into the close yesterday. So it's almost like you had like a 1 day. Yeah, here goes Tesla's testing this push through a 1 day. Oh yeah, and there goes Nvidia now to the upside. So a little bit of a 1 day setback on CPI. People are like, oh yeah, the next thing is let's rotate over, but don't actually see like a massive disaster forming here. No, not at all. And it's all seems to be. I mean, again, we're basing it off the first 20 minutes over here, but there you go. Tesla's about to push through that line over here, so not bad. There you go. Push it. And there it goes. Get through it. Look at that. There you go. Okay. So not bad. Could have been a lot worse. Could have had a continuation of the pain that you had yesterday, which you definitely don't want, because boy, that was crazy. So now it's just a matter of, okay, is this a how you say, is this you know, just gonna, are we just sort of gonna go back to, okay, well, everything goes up then, you know? Maybe it's not a market of just small caps moving up. You just go back to, we're right back to the rally, which is what we talked about yesterday. We're like, look, there are two ways to go here. If we don't stabilize within the next day, it's bad. Best case scenario, you stabilize and you go right back to you know, the stuff we had before. You know, you had some bad news on Tesla. Okay, big deal. But that's behind us now. So now we got the news. Do you go back to the momentum that you had previously? Possibly. Worst case scenario is you get a continuation of a mega cap sell-off. Absolute worst case scenario. Fortunately, that's not what's happening today, which is good. So it indicates yesterday really was just some form of you know, trade cycle on you know, CPI. That's it. Otherwise, Qs, Nvidia. I mean, look, IWM's going down. If anything, you're getting like the unrotation, and you're going back to the mega caps. You know, you can't make this stuff up. It's like you could have repositioned yesterday into the smalls, and now all of a sudden you're like, crap. You know, it's kind of wild. So, oh well, what are you gonna do? I don't know, but it is very interesting. So, something I suppose to pay attention to. Okay, then what else do we have here? Apple's moving nicely. You've got, let's see here. Let's go with, I'll take a peek over here. Okie dokie. Okie dokie then. Let's see what the doomers are saying.
But the CEO in the statement, interestingly enough, really tried to point out that they are really focusing here on that recurring fee revenue. Still, you see every one of these banks so far in the red by at least 2%, 7% or more for Wells Fargo.
Well, tell me a little bit about Citigroup, because we were chatting before the show, and it's Wells Fargo, it's JP Morgan, then Citigroup has some idiosyncratic issues going on there.
Yeah, it's totally in a league of its own here, because if you think about where the expenses are coming from, they just got ahead of it more than any other bank because of that big restructuring they really had to do, the reorganization. They're feeling the benefit now. Their efficiency ratio is down. Interestingly enough, a lot of the businesses that they said that they would focus on now, trading, for example, you're seeing some gains, equity trading blowing through estimates, and some of that investment starting to come back, though we know, and this gets us to our next story, the investment banking division still has some gains to go. And next up, we are going to talk just about that. Citi's new investment banking chief was granted shares worth $41 million to replace the compensation he gave up when he left JP Morgan. And of course, guys, as we've been talking about, this is all in an effort for Citigroup to really punch above their weight in the big leagues here.
I mean, $41 million is a big pay package even by Wall Street standards, right? I mean, this guy has enough money to buy his own private island now. What does that compare to in terms of, for example, CEOs across the street?
I've heard there are islands up for sale, but beyond that, you know, even CEOs, to your point, if you think about the biggest banks, it's in the $20 to $30 million range in a given year. But this was a big hire coming from JP Morgan at the highest levels of their investment bank. JP Morgan is always top 3 in advisory. Debt underwriting, I've got to say, is where it would be the most interesting. JP Morgan brought in more than $1 billion in the quarter alone on debt underwriting.
Right.
And Citigroup less than half of that. It's an opportunity.
So $41 million, big headline there, definitely gets Matt Miller's eyeballs. It's interesting to look into the details of the compensation, how it's structured, because the award, it vests in 6 installments from January 2026 through 2031, and none of the award eligible for immediate sale. So some interesting details there.
Well, they want to keep golden handcuffs, right? That's what they call them at the end of the day.
I would happily wear them.
There's one more story here I wanted to talk about. Of course, finally, the biggest hedge funds are off to one of their best starts in a year, aided by stocks and quantitative investing, while those focused on macro trading are lagging behind. And guys, this also ties into the big bank story, actually. Don't get bored.
No, I'm not bored. I'm
here.
just saying, no. But the thing is, the average gain is 13%. That's what we're celebrating, right? I would rather just buy the S&P. What's the cheapest?
Yeah, the S&P 500 is up like 17 or something. I saw that too. I thought that was funny.
Better performance.
Hey, listen, if you want to slam on the hedge funds, I won't mind it all day, because, you know, you have to think about they're also operating at essentially...
Everybody bags on the hedge funds. And the reality is some years the indices... I mean, it's not every year the S&P 500 is up 17%. In fairness, like 13% in a normal S&P 500 year is net outperformance likely.
That's the point. I think what's more interesting in all of this is that the macro funds are getting weaker, and you are starting to see that in the fixed income trading numbers at these big banks.
All right. Interesting stuff. Fascinating stuff, Shanali. It's a great day for you.
It's almost over.
There'll be more bank earnings coming out.
One more hour.
Let's get to the trading diary, what you need to be watching today and next week, really. Today, we're going to get University of Michigan, just a couple minutes, top of the hour, consumer sentiment. Bank earnings continue with Goldman Sachs reporting on Monday, followed by Morgan Stanley and Bank America on Tuesday. And then from Monday to Thursday next week, as Shanali mentioned, outside of banks, we'll have special coverage on the ground in Milwaukee, Wisconsin for the Republican National Convention. This is Bloomberg.
All right. Let's listen in over here. It's Fox. How about... Is Sarah still here?
We're coming off that cyclical correction.
That's not Sarah.
Harsh, thank you. Thanks for sticking with us. Have a great weekend. Appreciate it.
Thank you. Thank you for having me.
When we come back, S&P trying to close out the week with a small gain. We'll see if Michigan can cap off this busy week of macro prints when we return.
God, they all went on commercial right when I'm trying to write something. One sec. Give me one. There we go. Okay. All right. There. Cool. All right. So, Christopher Tyler, $20 donation. You think Tesla breaks $250 today? That's where I got a line. Also, thank you for all you do. You have paid for my courses over and over again with your stock analysis. Well, thank you for that. Yeah, we do have a coupon code expiring today, 11:59 p.m. Make sure to check that out. My goal always, every day, is just to try to provide whatever insights I can. And we like doing fundamental analysis, like doing everything we can to provide details. Then we've got, let's see here, Tesla, Enphase getting stuck a little. Apple, nice rise on Apple here. You know, I think the Apple AI play is much more valuable than what you're going to find at something like an NVIDIA going forward. I know that sounds crazy, but I've been saying it for a while here. DJT, 139, IWM. See a firm's rotate. See, look at this. This is like the anti-small cap move right here. But anyway, let me answer this question here. So, do you think Tesla breaks 250 today? You know, it seems like a firm just went negative. I think broadly the answer is probably yes, mostly because you have the upward trend. You had a big sell-off yesterday. You literally hit 270 yesterday. Buying it in the 240s might be seen as a bargain for some. The robo-taxi event, I put zero valuation on the robo-taxi event anyway, so I don't really care about the robo-taxi event. It being delayed, honestly, in some way, there's this chance, of course, it could hurt momentum, but it could also just drag the momentum out longer, right? So, yeah, I mean, I don't know that I would be betting on Friday call options on this one. I'd rather go out the curve a little bit, or the calendar a little bit. Thinking bonds here. University of Michigan, 5-year inflation comes in at 2.9 versus 3. 1-year inflation, 2.9 versus 3, so better than expected. And the expectations, sentiment levels came in a little weaker than expected at 67.2. Current conditions, 64.1, a little weaker than last month, and a little weaker than expectation or consensus. All of the sentiments came in a little lower, but that also included lower inflation. So Q's here just trying to get back to $500 basically. But this sell-off in the macro looks like it was just isolated to yesterday, which is fantastic. You really don't want a macro sell-off. That's like the thing I am literally the most fearful of this year is some form of a macro sell-off, because it's going to lead to unemployment and it's going to end up leading to a recession.
At 2.9, 2.9 would represent the lightest month-over-month level of inflation outlook 5 to 10 years since March of this year, when it was 2.8%. We see a little bit of movement to the downside in yields based on the weakness here. And if you look at the equity markets, they're still holding lots of green today. And at 420, or excuse me, now down to 419 for a 10-year, that is down 2 basis points on the session. It's down 9 basis points on the week. Sarah, back to you.
Yeah, market seems to like it. Weaker growth, lower inflation expectations. Thank you, Rick. And good Friday morning, everyone. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen here with Carl Quintanilla and David Faber live at Post 9 of the New York Stock Exchange. Take a look at stocks. As Rick said, we are seeing some strength for the S&P, up about 0.5%. So we've been building on some gains since the open. What's leading us today? Well, it's utility. Consumer discretionary is actually one of the better performing, and technology is higher right now, up 1%. Energy, financials, communication services are your lagging sectors. So we are coming back from yesterday's losses. NVIDIA has turned higher. Apple's higher today. Tesla also turning positive. Meta, Microsoft still under a little pressure. Take a look at treasuries right now. Whipsawed by some of the data, though the trend has been lower yields throughout the week. Very friendly number on CPI yesterday. PPI goes the other way, potentially why you're seeing these firmer yields, but still the 10-year note yield under 4.2%, and the 2-year yield is actually moving south, under 4.5%. 30 minutes here into the trading session. Here are some movers we're watching. The big banks front and center kicking off earnings season. We're going to drill down on results from JP Morgan, Wells Fargo, and Citi. In just a moment, with all three of those stocks lower, Wells Fargo gets hit the hardest, down more than 7%. Shares of Tesla have reversed. They're now higher. They started lower after a dramatic decline yesterday, snapping an 11-day win streak. The stock coming off its worst daily performance since January 25th, when it fell 12%. Also, AT&T shares are lower. The company says hackers stole nearly 6 months worth of calls and text messages, records of nearly every AT&T cellular customer. AT&T saying the data was stolen from Snowflake's cloud platform. Those shares down even more than AT&T.
That's why. Okay, I was wondering. I hadn't gotten the full story on that yet. So the problem, like the loss, occurred because of Snowflake. Oh.
Inflation is in focus. So the celebration was off of CPI. PPI was a little bit firmer. It didn't exactly go the market's way. The core number, 3%. So there was a little bit of a tick up. The core number, 0.4% higher on the month. But if you go through the details, it doesn't appear that the market is particularly worried about it. Carl, the culprit was trade services, which I guess margins on some of those services in the wholesale level go up, and there was a almost 2% pop on the month. But if you look at some of the inputs that go into the much more important PCE number, which the Fed targets for inflation, which comes out at the end of July, like medical services, those were a little bit lower. And so I think economists are coming out and still looking for a PCE number that looks around 2.6% from last year, and that still represents progress, certainly for the Federal Reserve. I mean, some of the numbers that were weird below the headline were airfares, which showed a little bit of a tick up in the month, portfolio services, but that's really just tied to the stock market. And then there were other measures, including energy, that were soft on the month, and PPI.
Indeed. Meanwhile, Russell on pace for its best week of the year with a 6% gain for the week. We talked to Gary Cohn yesterday about curve de-inversion, as I think we're down to, 30-ish basis points or so?
Yesterday we were down to 30. I want to look at today.
This is a story. He thinks it will get there by next year, where we're seeing the short end of the yield curve, short end come down, long end still stay elevated. Obviously, we have deficit problems, so that comes
down at 28.6 right now,
which also relates to some of the outlooks from the banks today. But as far as the Fed, this was a week where the market gained more confidence that it can cut. And some of the early reaction from some of the members of the Fed are worth highlighting. Austin Goolsbee, Chicago Fed president, who's not a voter but still, a voice. My view is this is what the path to 2% looks like. He was obviously very happy to see yesterday's number. We heard from Mary Daly of the San Francisco Fed, who is a voter, with the information we have received today, which includes data on employment, inflation, GDP growth, and the outlook for the economy. I see it as likely that some policy adjustments will be warranted. So they are getting there. They're moving closer and closer. And then on the other side of their mandate, which is jobs, and we watch growth and that sort of thing, we did get the CNBC NRF, National Retail Federation, consumer read today. And I just want to highlight it because it did show a tick down in the month. It's worth mentioning because next week, the big highlight of the week will be retail sales, the official government report. And we strip out auto and gas to get a core retail read. So that's what I've been looking at. And we saw a step down on the month, only grew 0.3% for the month, which was lower than the 1.2 that it had grown the previous month. We saw the same kind of trend on the headline number, some weakness in various categories, excluding online. Online was very, very strong. But I think it jibes with, David, what we just got from consumer confidence with Rick, which was lower and lower inflation expectations. Is this what a soft landing looks like?
Everything seems to be heading into the expectation for a September cut, right, Sarah? I mean,
September
but
cut,
as you've made the
December
point,
cut.
we've got plenty of reports yet to come. If there is something that goes against trend, that'll be an interesting day as well.
Right, and I don't think that PPI was deemed to do that necessarily. It's not as important, doesn't really tilt us off too much when it comes to the PCE read. But yes, 2 more inflation reports, 2 more jobs reports, more evidence of weakness in jobs and disinflation would be the recipe for the Fed to get on a path now to cutting and not just a sort of one-off adjustment. The question is, what does an adjustment look like versus a broader easing cycle? That's something that we're going to have to debate here.
All right, let's turn to the broader markets this morning.
Okie dokie then. So I was just watching the IWN M Russell 2000. There's I wanted to mention this because some folks were asking me, they're like, hey, we got TQQQ and SQQQ for a bull bear triple leveraged ETFs. You have these for the IWM as well for the Russell 2000. So go TNA. That is the 3x leverage small cap ETF. And so whatever the small caps ETF is doing, this will 3x that in the bullish direction. And TZA is the bear version of that. So if you think small caps are going to fall, you go for TZA. Now again, 3x leverage, so very risky, something to keep an eye on. Obviously, if we were going to have a pure rotation into smalls and away from megas, Apple and Nvidia wouldn't be up today, and the NASDAQ wouldn't be up 70 basis points. You'd want to be short the NASDAQ. But that's not happening, which is actually a good thing. You don't want NAS to go down the way it did yesterday again today. Would be very bad. So that's good broadly for the economy. But anyway, here's TNA. Some folks were asking about that. So here's the info on that. As far as any other market news, we talked about Michigan. We talked about PPI. I really think the PPI numbers were kind of a nothing burger. It's kind of bullish, honestly. And yield curve, again, moved a little bit, but not much. 10 years basically flat. So, and there goes Apple. So, all right, now I'm going to push the button. We're going to head over to the Course Member Livestream. Here we go. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. There it is. All right. Thank you so much for being here. See you Monday. All right. See you, everyone. Bye.